Why is the 10-year yield reacting this way? Why does the 30-year look like this?
So last week was very technical in nature, and the CFTC data confirmed that. People got caught offside. They were long equity, they were short bonds. You had the double shock to that trade, first the Omicron variant, and then you had Chair Powell's surprise announcement. And that does caught people offside. And what we've seen is a massive repositioning of a crowded trade. So last week was technical, but more generally, I would encourage you every day to look at the yield curve, not the level of yields, but the yield curve. And that is starting to signal more concern about a policy mistake, which is the Fed not going fast enough in the beginning and then having to overdo it later on. So that's why you're seeing these curves flatten, with the 2-10s now down to 76 basis points.
So that's what you think the message is from the markets these days? I mean, that's pretty complicated, that they're not going to move quickly enough, but then they'll have to do a whole lot to catch up, and that's going to hurt the economy pretty extremely?
Yes, and that's the worry, okay? And that inflation has become, as I've said to you in the last few weeks, the major threat to the markets. That the Fed simply has underestimated the inflation threat. It has stuck to the transitory call for too long. And now it is exiting that call, but is doing it late. And it's doing this in the face of two other developments, which is a new COVID variant and what's happening in China. So that's why the market is starting to sense this notion that we are going to have a policy mistake that will add in the short term to the stagflationary winds, and in the long term may well cause the risk of a recession.
If you look at commodities prices, lots of commodities, but let's just take oil as an example, it has come down precipitously. I mean, it's dropped for the last 6 weeks in a row and is now below $70 a barrel. 68.07 is where we're sitting this morning, so barely above 68. If you're looking for inflation in places like that, it's not there. I guess what you're talking about is the bigger concern that this works its way into wages, and maybe that's exacerbated by a new variant that keeps some people not wanting to go back to work. Is that what you're talking about when it comes to this?
You're absolutely right. If you look at inflation cycles in the past, and I want to stress, we're not going back to the 70s, but we're going to something that neither the economy nor the markets are wired for, which is inflation that persists above 4% for a while. We may even get a 6.7, 6.8, 6.9% print later this week. So this is serious inflationary pressures. What tends to happen in a typical cycle is you have an initial dislocation, commodities being one, it could be something else, but an initial dislocation that is not taken seriously and then starts changing behaviors. And the two behaviors it changes are wage earners' behaviors and price setters' behaviors. And we have a lot of evidence that these behaviors are changing on the ground.